Hello, this is Robert Guillaume. Thank you for joining me on Your Money, Manage It. I will be discussing principles that will empower you to manage your finances made easy. Thank you for joining me today. The past 3 episodes, we focused on how to work through a financial management program through the holiday season when spending is so vibrant, and how we can manage ourselves as a family or an individual through that time. Today, we're going to shift gears just a bit as we approach the new year. I would like to focus on the subject of discussing a financial tool with you, and that's called insurance. I know to many people, insurance is kind of a taboo word, and they, I don't know. But I want to focus on the various types of life insurance specifically, and how you can use them as a tool for your financial management, for your entire portfolio. Many individuals are unaware of the uses and types of life insurance, and they can be caught buying life insurance from sources and paying for what they really do not need. Life insurance, however, does provide financial resources to protect the stability of an individual, of a family, for your partner, for your children, or other personal relations. Well, let's begin this discussion by discussing one type of life insurance, and that's called whole life. Whole life insurance is very basic and it's very simple. You estimate or establish an amount of coverage. Let's say you would like $25,000 in whole life insurance. The premium for that is based on a dollar amount per $1,000 of coverage, and it's also based on your age at the time you enroll in the program. A whole life policy usually continues until you reach the age of 65. At that time, you usually have what's known in the industry as, quote, paid up, end quote, insurance for a certain dollar amount. With whole life insurance, the premiums will not change. The premium you established for that policy when you take it out will remain the entire time you have the policy. And most whole life policies will build what's known as cash value. That's literally your money that the company has invested, and now you have some cash value that you have earned over the years. You can sell a whole life policy or cancel it, at any time. There are no stipulations on that. You can just say, I wish to cancel the policy. There are also dividend-paying policies that will pay you from the investments of the company a dividend, and sometimes the companies will allow you to take that dividend and put it toward the premium of that policy. So that's not a bad thing. Now, many times, whole life policies are a good foundational policy. There are multiple forms of a whole life policy: permanent life, universal life, variable life. But a whole life policy can be, we'll discuss it further later, a foundational basis for setting up a life insurance portfolio. Another form of life insurance is called term life. What a great financial tool this is. It is a good value of insurance for your premium dollars. Term policies are usually based upon the term or the length of time that you want the coverage. The amount of coverage that you want is based again per $1,000, and again it's based on your age at the time you enroll in that program. Term life insurance is a great mortgage insurance. Allow me to explain this. Let's say you have a mortgage of $150,000 and you're age 25. Well, you can take a term life, it's called decreasing term, and you can take that term life insurance policy out very cheaply for $150,000 at age 25. The way it works is as your mortgage is paid down, the term insurance decreases. So they're both going to approach zero at some point in time. And in the meantime, you have not spent a large amount of money to protect your mortgage should something happen to you. There is also another aspect of decreasing term that you might find in the fact that if you need insurance to cover a specific need for a period of time, decreasing term is a good tool to look into for that. Term insurance comes in multiple forms, and another form of term insurance is known as level term. Now, level term insurance is a specific amount of insurance, let's say $15,000, and it's set up for a specific amount of time. However, the value of the policy, the $15,000, will remain level, but your premiums are usually based upon your age. So over time, as you get older, the premium will increase. Here's an example. Let's say you have $50,000 of level term insurance at age 25, and let's say the premium is $20 a month. Well, that $50,000, when you reach age 30, will probably jump to $28 a month. And when you reach age 35, it jumps to $34 a month for that $50,000. So the amount stays level, but the premium will probably increase on a level term policy. Now, let me share this with you as an audience. Some companies advertise level term policies for seniors. They advertise and they say, oh, it's $9.95 per month and the rate will never increase. And you think, oh, wow, I can get this insurance and my age is, let's say, 70 or 75 or 80, and I can get this insurance for $9.95 per month. Excuse me. Well, there's a little quirk to that. That may be true, but you must realize $9.95 is per $1,000 of coverage. You can't read that fine print on the TV screen. But based upon my professional experience, I will tell you that $9.95 is per 1,000. So if you want $10,000 of coverage and you're age 78, then that will cost you $99.50 a month. Be aware of that. Again, the advertising looks good, but you really need to check the fine print details. Another great tool of life insurance is group life insurance. Now, I'm just saying this because you might check with your employer or you might take advantage of it if it's offered. Group life insurance is usually offered by an employer. And group life insurance is a type of term insurance, but it's a great rate for a fixed amount of insurance. Sometimes the company will say, we automatically will provide you $50,000 of life insurance. It's a term policy, level term, for X number of dollars. That's a great deal. And they give you an option that many times you can buy additional insurance at that great rate. I know a lot of school corporations and a lot of businesses will offer group life insurance packages and opportunities. And that's really good to look into. It gives an amount of insurance. It could be $100,000 or $150,000 that you're allowed to take, and you can do it at a great rate. That just adds to your insurance portfolio to protect your family and all of the resources that you want to protect. Usually a very good deal. Well, let me share what might be a packaged insurance portfolio, because we've discussed a whole life policy, we have discussed decreasing term policies, we have mentioned level term policies, and now we have mentioned group life insurance. So if I might, from a professional position, just kind of share what might be an example portfolio with you. Perhaps, especially if you're a young family, it's a great way to start, because whole life is usually cheapest by far when you're young, in your 20s, early 30s. So let's say you want to put a foundation down for an insurance portfolio, and you might consider starting with, let's say, $25,000 worth of whole life. And you might say, well, why not $100,000 or $150,000? Well, whole life's expensive. I will tell you, professionally, the commission rates on whole life are pretty good for the seller. But whole life, one of the most expensive areas of insurance. So let's say you start out and you put down a $25,000 whole life policy as a foundation. Then it's very feasible to add term policies to meet the needs beyond that point. If you get group insurance from where you're employed, or if you use decreasing term or even level term, and you can even use level term inexpensively to insure another member of the family, those can be combined to build you an insurance portfolio that will take care of your projected needs. When I say projected needs, you think about what happens to my family if something happens to me, or what happens to the children if something happens to both of us. And let's face it, those things sadly do occur, and insurance is a great way to protect, without a lot of taxation involved and so forth, protect the needs of a family or a spouse or whatever. There's another form of insurance that I'll just briefly discuss, and that is annuities. Now, we have all heard of annuities, most of the time from the terminology of investment annuities. And those investment annuities are handled by insurance companies. Now, I'm not going to sell or not sell annuities. I will tell you that as an investment part of your investment portfolio, as I speak to you today, many investment portfolios sadly have tanked. The stock market has taken huge plunges. People have lost thousands of dollars on investment and retirement portfolios in 2022. And annuity investments basically are built on the fact that when times are good, you earn good money. When times are bad, they flatline. And you usually, with a good annuity, you do not go below zero. Now, you may not earn anything, but you won't take a financial hit in the negative direction. Now, the one aspect about annuities, especially when you're young, you can take an annuity policy that has both a life insurance and an investment scenario. The way that works, let's say you have it sounds like a lot, but let's say you have a $200 a month premium. Well, what that equates to is part of that $200 premium will go toward paying a certain amount of term life, whatever you have decided on. The balance of that will go into your investment annuity. So you're building both. You have the the life insurance coverage on your left hand, and then you're building the annuity portfolio on your right. And I know of some personal cases where people have taken out an annuity policy of just that nature, and at age 25 or so, and by the time they've reached almost retirement age, they have a substantial buildup, when times are good, in the investment part of that annuity. So they've had life insurance, and then they have built a good retirement or investment portfolio through the other part of that annuity. So I think in a short closing on insurance today, be knowledgeable about life insurance. Don't be scared. Be knowledgeable. It is a management tool. It will help provide resources that will, take care of your mortgage insurance. It will help provide for a family need if that need should arise. And it can be used as an investment tool for the future as well. Use life insurance as a resource tool along with other aspects of managing your personal finances. I would not put all my eggs into a single basket. I'm not going to take this opportunity to discuss investments, but I think a diversified portfolio is wise, especially in uncertain times. And remember, don't fall for paying higher premiums for life insurance. Manage your portfolio. Use some of the examples I've given you with the different types of life insurance that are out there. Openly discuss these with an agent if you have an agent that you know, because, again, commissions vary on their part. So, it's like selling real estate or anything else, a car, an automobile, and when there are commissions involved, the seller would want to get the higher commission rate. So discuss it openly, explain your needs, and follow through with being as knowledgeable as you can on the subject when you approach it. If you would like to submit a question to this program, you may do so by submitting an email to officialrlguillaume@gmail.com. I hope that this has been some information on the business of insurance, life insurance as a financial management tool. And I would just say thank you for listening and have a great day. Thank you for joining me on Your Money, Manage It. My book, How to Manage Personal Finances Made Easy and Avoiding the College Debt Trap, can be found on Amazon and the Bookshop. I will also include the link in the description of this episode. Find me on Facebook, LinkedIn, and Instagram, and join me again next Monday. Thank you for listening.